Welcome to the Deep Dive. Today, we're tackling maybe the core financial question everyone faces. Where should your money actually go?
Right. Is it into yourself? Building skills, staying healthy, getting your mindset right?
Or is it all about the traditional stuff? Stocks, real estate, mutual funds, the institutions.
Yeah, and look, this isn't just like a matter of taste. Our sources are pretty clear that this decision, this strategic choice...
It really separates people.
It does. It's the difference between always feeling like you're playing catch-up, financially speaking, and actually building real sustainable wealth.
So our mission today really is to give you the clearest, fastest blueprint we can distill from all this. Finding that right balance for accumulating wealth over your lifetime.
And we should probably start with that timeless bit of wisdom from Benjamin Franklin. Seems more relevant than ever now.
Oh yeah, an investment in knowledge pays the best interest. Simple, but profound, especially now.
Definitely. The stakes feel higher, don't they? With AI changing industries so fast, markets being, well, unpredictable.
Yeah, you can't just say blindly anymore. You need a smarter game plan.
And here's the key thing you need to grasp right away. It's not an either situation. It's not self versus institutions.
Ah, okay. So not a competition.
Not at all. Think of it more like a symphony. You need both playing together strategically. Decades of financial analysis back this up. The secret sauce is balancing them dynamically.
Like a pro portfolio manager would.
Exactly like that. And we've actually got some hard numbers, a kind of allocation guide based on where you are in life.
Okay, let's hear it.
So if you're in your 20s, the blueprint points towards putting, say, 70% of your investment focus on yourself.
70%. Wow. Okay. Why so much?
It's all about igniting explosive income growth early on, building that core earning power. But then as you get closer to your 40s,
Oh, shit.
dramatically,
Yeah.
you start leaning maybe 60% towards institutions. The focus changes to stability, preserving what you've built.
Got it. So the big takeaway, really, from all the sources
Is that in this era of, constant disruption, your single best appreciating asset isn't hiding in a brokerage account. It's you. Unequivocally you.
Okay, let's dive into that 70% self-investment idea for younger folks. Because honestly, it sounds a bit counterintuitive compared to save 10% in your 401k advice.
It does initially, but think about it this way. Treat yourself, your body, your skills, your mind like a high potential startup.
Okay, a startup. Might be a bit strapped for cash at first, but the potential upside.
Is basically limitless. Uncapped scalability. That's the key difference.
Right, because self-investment can have this almost uncapped return on investment, ROI. Not like a stock where you might aim for, 8%, 10% a year if you're lucky.
Precisely. Investing in a skill, a targeted one, can genuinely give you a 10x, even 100x return over your working life. We found a concrete example. Spending, say, $5,000 on the right coding bootcamp.
Yeah.
Could literally add $100,000 or more to your earning potential within the first year or two. That kind of immediate leverage is huge.
That sounds amazing, but hang on. What if you pour 70% of your available capital into yourself, into that boot camp, and it doesn't quite work out? Or the industry shifts? Isn't that, kind of risky? Especially if you keep cash.
That's a fair point, a really important one. And the sources address this risk by focusing on resilience through skills.
Okay, how so?
Well, data from the World Economic Forum shows that consistent upskilling, especially in hot areas like AI, data science, even specialized communication, it doesn't just give you a one-time bump.
Right.
It can boost your salary by 20, 30, even 50% within a year or so. And crucially, it makes you more adaptable, more recession-proof, you could say.
So it's like building armor.
Kind of. It backs up that old Jim Rohn quote, income seldom exceeds personal development. Your range of skills becomes your personal safety net against economic shocks, much more effective than just a small emergency fund sometimes.
So the real goal isn't just a quick pay raise. It's building a more robust, adaptable economic engine. You personally become more valuable.
Exactly. And you even see echoes of this in someone like Warren Buffett's story. People forget his empire didn't start with huge capital.
It started with
Reading 500 pages a day. That was pure self-capitalization.
Yeah.
Building that deep knowledge base before he started making the big institutional plays.
That's a great point.
Yeah.
So self-investment isn't just courses and skills. It includes Health.
Absolutely critical. You should view your health almost like high-yield bonds. Seriously. High-yield bonds, how does that work?
Well, think economically. Investing in your health is like insurance against future lost income and massive costs. Some Harvard studies suggest even a modest investment, like $100 a month for a gym or a fitness app, could genuinely add 5 to 10 healthy, productive years to your life. Translate that into earnings. It's potentially $500,000 or more in extra lifetime income.
Wow. Okay, that reframes the gym membership cost. And what about the mental side? Stress, focus.
Just as vital. We saw data suggesting apps like Headspace or Calm can show something like a 300% ROI.
Simply by cutting down on stress-related sick days and boosting concentration, it pays off directly.
So when we talk education for self-investment, the advice is less about expensive degrees.
Very much so, especially early on. Forget burying yourself in student loan debt for a general MBA if you're just starting out. Focus
on.
Targeted, specific skills. Use platforms like Coursera, Khan Academy, even free resources like Investopedia for finance skills. The real pro tip here.
Go on.
Block out 5 hours a week. Treat it like a non-negotiable appointment for learning, like it's your most important stock pick.
I like that. Non-negotiable learning time. And for, like, right now, 2025. Any new twists on self-investment?
Yeah, definitely leveraging AI tools. Spending, say, $20 a month on ChatGPT Premium to help with research, drafting, maybe automate some tasks.
That frees up time, which is money.
Exactly. If it saves you even a few hours a week, that's massive leverage. Or using your expertise to build a personal brand online, maybe on Substack, creating another income stream. That's pure self-investment monetization.
Okay, that makes a strong case for focusing on yourself first. But let's pivot now. What about the other side of the coin? Institutional investments.
Right. So if self-investment builds the powerful engine, think of institutional investments as the reliable, diversified fuel needed for the long journey. The blue chip stocks, if you will.
And this is where that magic concept, compounding interest, really comes into play, right?
Oh, absolutely. It's almost like a financial fairy tale. But it's real. We often underestimate its power. The sources hammer this home. Start early, be consistent.
And even a relatively modest amount, say $10,000.
Over 4 decades, assuming a historically reasonable 7% annual return, could easily grow to over $1 million. It's the power of time.
And there's that quick trick, the rule of 72.
Yeah, simple but useful. Just divide 72 by your expected annual rate of return. That gives you a rough idea of how many years it takes for your money to double.
So institutions offer that kind of predictability, that stability that maybe your own career ups and downs can't always guarantee.
Exactly. And they offer something else crucial: diversification.
Spreading the risk.
Right. If that coding skill you learned suddenly becomes obsolete or your industry takes a hit,
your whole financial world doesn't collapse.
Hopefully not, if you're diversified. Investments in broad market index funds like Vanguard's VTI, which tracks the S&P 500, act as a buffer. You're hedging against specific failures by owning a tiny piece of everything.
And this is where passive income starts to become a reality too.
Yes. This is classic Robert Kiyosaki territory. Acquiring assets that, as he puts it, put money in your pocket.
Like dividends from solid companies, Apple, maybe. Or rental income from properties, perhaps through REITs.
Exactly. Real estate investment trusts. It's cash flow that doesn't depend on you showing up to work every day. That's a different kind of financial freedom.
Plus, we can't forget the tax advantages. Those are huge.
Immense.
Yeah.
Using things like 401ks, IRAs, especially Roth accounts, where growth and withdrawals can be tax-free. It's like putting your money on steroids. It compounds faster because taxes aren't dragging it down each year.
So when it comes to smart strategies here, what's the blueprint? Who do we look to?
Well, you often look to the greats, right? Channeling someone like Warren Buffett usually means value investing.
Buying good companies when they're cheap.
Essentially, yes. Looking for companies that are undervalued by the market but have strong fundamentals, especially what he calls economic moats.
Moats, like competitive advantages.
Exactly. Things that protect them from competition, like Coca-Cola's brand or Amazon's distribution network. For beginners, aiming for a realistic 8 to 12% compound annual growth rate is a solid target.
Okay, but this institutional side, it also seems to have this risk divide, doesn't it? You mentioned Kiyosaki.
Yeah, he's famous for advocating leverage, using debt, especially in real estate, to aim for those massive 100x type returns.
Which sounds exciting, but also risky.
Extremely. And that's where you have to bring in Buffett's warning. Risk comes from not knowing what you're doing.
So the advice isn't necessarily to copy Kiyosaki's high leverage plays right away.
Definitely not for beginners. The core message is scale your institutional risk only as your knowledge grows. Don't jump into complex strategies blindly.
So what's the starting point?
Keep it simple. Start small, maybe just $100 a month. Use one of those commission-free brokerage apps, learn the ropes, get comfortable, then consider more advanced stuff.
And looking ahead, 2025 and beyond, any specific institutional angles?
Well, there's always debate. You might want some exposure to growth areas, maybe tech through ETFs like ARKK.
Yeah.
But you need balance.
Balance like?
Like Kiyosaki also pushing for hard assets, gold, maybe commodities as a potential hedge if you're worried about inflation eroding the value of regular currency. So institutional investing needs to be dynamic too, not just set it and forget it entirely.
Okay, this is great. We've covered both sides. Let's try and bring it all together now, sort of a showdown and synergy section.
Yeah, let's synthesize this for the listener. What are the core trade-offs?
Okay, head-to-head, ROI potential. Basically unlimited on the self-investment side, right? Versus a more predictable, maybe 7-10% average long-term from institutions.
That's the big one, but then there's risk.
Right. Self-investment risk feels emotional.
Yeah.
If your venture fails or the skill doesn't pay off, it hits hard personally.
Yeah, it can feel debilitating. Whereas institutional risk is more about market volatility. It can sting, sure, but it's less you. And crucially, you can mitigate it with diversification.
Good point. And the time horizon is totally different too.
How so?
Well, self-investment can pay off almost immediately in your career, and those benefits compound over your whole life. Institutions, that really needs patience, doesn't it? Like 5 years minimum, maybe more to ride out the bumps.
Absolutely. Long-term game and the entry barrier.
Seems lower for self, right? You can listen to a podcast, read a library book for free. Institutions, even with apps, you usually need at least some cash, maybe $100 to get started.
True. So this leads back to that strategic application, the hybrid approach based on where you are in life.
Let's recap that. Early career.
Lean heavily into self-investment, maybe that 70%, even 80%. Build the income engine first.
Midlife, mid-career.
Start balancing it out, maybe closer to 50-50. Shifting focus towards building that institutional base while maintaining skills.
And then approaching retirement.
Flip it. Maybe 70% or more in institutions. The goal then becomes capital preservation, making sure the nest egg lasts.
Got it. And that ongoing debate, that philosophical split between, say, Buffett and Kiyosaki.
It's really about how and when you apply leverage and focus. Buffett is about steady, low-risk compounding within institutions. Buy and hold quality.
Well, Kiyosaki is about using self-knowledge, often leveraging debt, to accelerate asset acquisition, especially in real estate, aiming for bigger, faster flips.
But accepting much higher potential risks, including bankruptcy. Your life stage, your risk tolerance, your knowledge level, these dictate which approach or blend makes more sense for you.
Okay, to really make these ideas stick, maybe we can use some stories or examples, parables almost.
Yeah, I like that. Real world or even film examples can make abstract concepts clearer.
Okay, I've got one for self-investment. Remember the movie The Pursuit of Happiness? Based on Chris Gardner's true story.
Oh yeah, powerful film.
He basically invested everything he had, time, energy, facing incredible hardship, into mastering sales skills and just relentless cold calling. Went from homelessness
to a high-paying brokerage job. That's a prime example. The lesson there is potent. Grit, combined with very specific skill development, can compound way faster than a small amount of starting capital.
Totally. And for the other side, maybe The Big Short.
Interesting choice. How does that fit?
Well, the main characters made huge institutional gains, right? Shorting the housing market. But how did they do it?
They invested heavily in knowledge first. Deep contrarian knowledge about how flawed the system was.
Exactly. Their self-investment in understanding the market unlocked the massive institutional play. The knowledge was the key.
That's a great connection. It shows the synergy. And classic finance books echo this constantly.
Like Rich Dad, Poor Dad.
Yeah, its core message is self-educate. Understand the difference between an asset and a liability. That's foundational self-investment.
And then something like The Millionaire Next Door.
Shows the flip side. Often, wealth is built quietly through consistent, maybe even boring institutional investing, combined with frugal living, which is itself a form of self-investment, right? Managing your resources wisely.
Okay, so let's distill this into a really clear roadmap. Someone listening right now wanting to start this dual strategy. What are the concrete first steps?
All right, let's break it down. 4 key steps we pulled together. Step 1, the audit.
Meaning?
Know where you stand. Start tracking your net worth. Just a simple spreadsheet, update it monthly, then consciously allocate. Maybe aim for 20% of your income towards self-investment books, courses, coaching, and 15% towards institutions. Use a simple app like Vanguard's or another low-cost broker. Just start the habit.
Okay, step 1, audit and allocate. Step 2.
Financial hacks. Use the system to your advantage. For education goals, look into tax-advantaged 529 plans if they apply. For health.
HSAs, health savings accounts.
Yes. If you have a high-deductible health plan, HSAs offer a triple tax advantage. Contributions are deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Amazing tool.
And for the institutional side?
Keep it simple and automatic. Use dollar cost averaging, DCA. Just invest a fixed amount regularly, say monthly, into broad market ETFs. Takes emotion and market timing totally out of the equation.
Love it. Step 3.
Avoid the traps. This is crucial. While Kiyosaki might see debt as a tool,
You need to be careful.
extremely careful. For most people, the source is strongly warned. Debt itself is a trap, especially high-interest debt, like credit cards. Unless debt is directly and provably generating more income than its cost, prioritize paying it off aggressively before you try to scale up investing.
Makes sense. Get rid of the leaks in the bucket first. Okay, final step. Step 4.
Scaling up. Once your income is steadier, maybe hitting around $5,000 a month or some similar benchmark, consider professional help.
Like a financial advisor.
Specifically, a fiduciary advisor. Someone legally obligated to act in your best interest, not just sell you products. Track your progress diligently. Aim for maybe 15% net worth growth year over year, and keep an eye on new tools.
Like pizza.
The 2025 edge here might be AI-powered robo-advisors, like Betterment or Wealthfront. They're offering increasingly sophisticated, personalized institutional guidance at a much lower cost than traditional advisors.
Okay, that's a really actionable 4-step plan. Audit, hacks, traps, scale.
Yeah, it provides a framework. Ultimately, wealth creation isn't about finding one magic bullet. It's a marathon, fueled by consistent habits.
So to wrap up, self-investment builds the runner.
Right.
Makes you stronger, faster, more efficient.
And institutional investment provides the fuel and the steady path for the long miles ahead. You absolutely need both, working together.
It reminds me of another Buffett quote. Investing is simple, but not easy.
Exactly. The concepts aren't that complex, really. The hard part is the consistency, the discipline, the patience. Markets will change, technology will evolve.
But these core principles, investing in yourself strategically, balancing that with steady institutional growth tailored to your life stage, they seem pretty timeless.
They endure. The sources really stress treating your skills, your health, and your portfolio as one integrated system that needs regular checkups and rebalancing.
Okay, so let's leave our listeners with something to chew on, a final provocative thought.
Right. If you really take that integrated view, analyzing your entire personal portfolio skills, health, finances right now, what's the one investment area, self or institutional, that you know you need to increase immediately?
Increase to maximize your personal margin of safety for whatever economic twists and turns might be coming next.
Exactly. What's that one crucial adjustment you need to make starting today?